Hello everyone. So today's topic I'm going to discuss is accounting concepts. What do you mean by accounting concepts? It defines certain assumptions on the basis of which financial statements of a concerned business are prepared. So why? The accounting concepts provide consistent framework for recording, reporting, and interpreting the financial informations. So with this, the financial statements, whatever you have prepared based on the financial informations, will be accurate, transparent, and reliable for taking certain decisions. So let us look what are the accounting concepts are. As you can see, there are a number of the accounting concepts, and all these concepts are given by the different accounting professionals. So let us go through each what exactly the each concept says. So the first one, business entity concept. According to this concept, the business and the owners are two different entities. So the business and the personal transaction of the owner are separate. For example, when the money invested by the owner in the business, it is recorded as liability of the business. Similarly, when the owner takes back or takes away from the goods, cash for his personal use, it cannot be treated as a business expenses. So in simple words, I can say business entity concept means I and my business are separate. So coming to the second one, money measurement concept. So as the name says, whatever the transaction that you're recording in the form of the business or in the books of the business, it should be in terms of money itself. For example, in India, it will be in terms of rupees. In other countries, for example, America, dollars. So, for example, you can see which are the business transactions here. Salary paid, yes, in the form of the amount you are paying the salary to your employees. So that is a business transaction. Rent paid, it is a business transaction because it is expressed in terms of the money. But whereas the particular person has been promoted in the company, that cannot be called as a transaction, that is a part of the event. If the particular sincerity, loyalty, etc., they are not considered or they have not been recorded in the books of accounts, the reason is it is not expressed in terms of the money. So in simple words, only those transactions which are recorded in terms of money should be recorded. The third concept is going concern concept. So according to this concept, while recording business transaction in the books of accounts, we assume that the business entity will be carried for indefinite time period. And that is the reason why the business will purchase certain non-current assets or a fixed assets like land and building. It could be plant and machinery, certain vehicles, laptops, furniture, etc. Suppose if the assumption of going concern may not have been there, we would have hired these assets and not purchased. So there is a beautiful definitions given by the International Accounting Standard. So according to this, the enterprise is normally viewed as a going concern, that is as continuing in operation for a foreseeable future. That means it is viewed that enterprise as an intention to be carried on for longer period because they have assets, liabilities, capital, so and so used in the accounting operation to prove that the firm has to last long. So that is all about the going concern concept. Moving forward, accounting period concept, one of the most important and required concept here. So what exactly accounting period concept? So according to this, all the transactions are recorded in the books of accounts on the assumption that these transactions are to be ascertained for a specific period. Suppose, look at going back to the going concern. The company will go for 200, 300 years. I cannot calculate the exact profits. I need a particular durations to calculate the profits, either a profit or a loss. So here, a proprietorship, it can be, or a partnership, they can choose their own accounting period, which has to be consist of 12 months strictly, which is restricted to the 12 months. I'm repeating it. So how this 12 months? We have two different years. One, the calendar year, and the accounting year, or sometimes we used to call the financial year as well. So the calendar year starts from 1st January of to 31st December of the same year, or you can call it as a current year, which I called it as a C1. At the same time, accounting year starts from 1st April of this year to 31st March next year. But for the companies, it is mandatory to follow the accounting period starting from the 1st April to 31st March of the next year. The reason for this concept is, so the companies can require that a balance sheet and a profit and loss should be prepared at a regular intervals. So this is necessary for different purposes like calculation of profit, ascertaining financial position, tax computations, payment of interest to the debenture holders, payment of dividend to the shareholders, etc. Next concept is dual aspect concept. So the concept itself assumes that every transaction has a dual effects. Like we get some benefits and we pay some benefit. Suppose if we buy stock, then it will have a two effects. The value of the stock will increase. That means we are getting the benefit for the same amount, and that at the same time, it will increase our liability in the form of the creditors. Suppose if we purchase any kind of a goods or a asset on credit transaction, that means buy now, pay later concept. So to be in a systematic way, dual aspect concept can also be represented in the form of the accounting equation where asset equals capital plus liability. So suppose I have started the business by investing in the form of cash, building, and creditors. So here, cash and buildings are the part of the assets, but creditors is a part of the liability, whereas all these three together called as a capital, where I am getting the amount. The next one is matching concept. As we know, the every business enterprise's objective is to earn the reasonable profit. The whole business structure is based upon the desire to earn the profit. But how do you calculate the profit? So according to this concept says that the revenue and the expenses incurred by the company should belong to the same accounting period. So if I talking about the accounting year for 2023-24, I should calculate the revenue and the expenses for the same accounting period in order to identify what is my end result, whether I'm ending up with the profit or with the loss. Suppose if the revenue is more than the expenses, we call it as a profit, and if the revenue is lesser than the expenses, then we call it as a loss. So this is what exactly has been done by applying the matching concept. Moving forward, the next one is realization concept. So according to this, the revenue from any business transaction should be included in the accounting records only when it is realized. For example, I have given here, selling the goods can be called as a realization, but receiving the order cannot be called as a realization. So what exactly the realization is all about? Realization means you are creating certain legal rights to receive the money. So in simple words, I can say the concept of realization states that revenue is realized at the time when the goods or services are actually delivered. So moving forward, the next is accrual concept. So accrual means something that becomes due. Due means either you are paying the amount in future or you are going to receive the amount in the future. So for that particular relevant accounting year. So it means that revenues are recognized when they become receivable. even though cash is received or not received. So for example, Mr. A buys clothing worth rupees 50,000 by making the initial payment of rupees 20,000, and later he sells the same cloth for rupees 60,000, of which the customers paid only rupees 50,000. So according to this concept, his revenue is 60,000 and not 50,000, and expenses is 50,000 and not 20,000, which is paid in the form of the cash. So let us consider this accrual concept based profit is whatever he is earning. He purchased for 50,000 and sells it at 60,000. So he's getting a 10,000 margin called as a profit. So this is what the accrual concept is all about. Last one is objective evidence concept. So according to this, every financial entry should be supported by some objective evidence. As you can see, I purchase some stocks. Yes, I should provide some purchase bills. Similarly, sale with sales bills. If I have done with some expenditure in the form of cash, I should give the cash memo as a proof. Suppose I made some payment to the creditors, I should support through bank statements. So that will be acting as a supporting documents. What happens in the absence of all this evidence? Manipulations in the accounting records will be very high, and accounting results will not be trustworthy, and no one will be able to rely on such financial statements. So hence, for any financial transaction that you're dealing in terms of a cash or a credit transaction, you should provide the some supportive documents. So thank you all. Hope this video finds some informative for your reference. So if you have not subscribed my channel, please do subscribe and share it among your friends. Thank you. Have a nice day.